Hello, my name is Dr. George Mochoc, and welcome to International Finance, a course you're taking me with, either on an online class or a face-to-face class. This is a supplement to our lecture or to our forums. You're taking this in a community college. What's required is you already should have had corporate finance as a prerequisite for this course, and to finish corporate finance, you'd have to have one or two accounting classes, which you already have. You have some understanding of the business. Now we're going to take this one step. So you already have corporate finance. So you already are aware of present value. You know how to use a calculator. You've been exposed to some of the financial spreadsheets that we've talked about in finance. Now we're going to go take this up to the next level. We're going to take the same strategy, the same thinking, but now we're going to look at it. How do I apply finance to the international setting? How do I open up a business, a direct investment, or a new business or operation in another country? Part of this course, this is the first chapter, so remember the first chapter is going to be a little bit overview. It's going to give you some basic understanding about managing a multinational corporation, some of the various different structures, and then again the value of a multi-corporation, a multinational corporation. And when they look at value, they look at values at different subsidiaries in different countries that they may be operating or have some kind of contractual agreement, either through a franchise or licensing or the different types of strategy that we're going to be talking about. And then we're going to talk a little bit about how this text is organized. The textbook is a little bit easier reading than your corporate finance textbooks because that was strictly a lot of math, a lot of formulas. This book here still has formulas, but the emphasis on this is to understand strategically how do I operate, what are the different vocabulary and concepts, if one is utilizing the financial understanding that he has or she has and is building it going into the international arena. So let's get going on this, all right? So we will have math, and right now I'm just going to go conceptually. Most of the chapters I'll talk about, and so you understand strategically the new concepts, build on what you've learned in the corporate finance and a little bit of accounting, and so you'll have some problems that you'll be solving. But the main focus of this whole course going forward is to understand, is give you a good, solid baseline of what it means to operate internationally and from a financial perspective. The calculations will be there, and once in a while I may have certain calculations, a separate 5-10 minute recording to show you how to solve it. But otherwise, this is just a quick overview. A high level view. If you understand how something is done in your mind, the math portion, the calculation makes sense, because I could give you the formulas, you could plug them in. What does that mean? I got an answer. Why did I get that? Why did I set up the problem this way? Why are these variables or these components important? That's what you're going to learn in this stage. All right, so let's look at a little bit of vocabulary. Well, we'll get going. Remember, we'll do fine. All right, and I try to, those of you who've had me in other classes, I give you the mind maps. The mind maps are in the second tier. You have to add in your own stuff. When you start doing, you read the book. There's no way you're just going to look at this hour lecture that I have and understand the material, because I'm not going to go into solving the problems. I'll talk about the equations and the formulas, but the author does an excellent job by giving examples so you could tie it in. And that's how you're going to learn any kind of finance. Finance is how do I take the math, but and solve it, and the math gives me a logical way of coming up with some kind of a variable that I can measure the financial status of my organization, and in this case the financial status of separate subsidiaries in different countries. Okay, so let's look at the vocabulary. Okay, and the vocabulary, and some of this vocabulary you already had it before. Let me just go on here, but I just go real quickly to vocab. Not too much. I'm just going to talk about it. Comparative advantage, direct foreign investment. So focus. So you look at the vocabulary, make sure I get it when I'm reading the book. Remember, you have my concept maps. Look at this first. Understand what franchising is. We're going to talk about it there. What's an imperfect market? What's the joint venture? What's licensing? You had that at the introduction to organization to organizations. If you've had me or other classes, if you've taken at a college level, and then multinational corporations and the product cycle theory. And the product cycle theory is when I look at subsidiary, I'm looking at the life cycle of my multinational products or subsidiaries, what they're making. Does it make sense? How long should it be in that country, or should I pull out of that country depending on what you're going to find out? The economic downturn in that region went down, or political unrest, something that's going to make me change something, that my product life cycle may be extended or what do you call it, or finalized, for lack of a better word. Okay, so that's our vocabulary, just, the main one. I'm trying a little different. Every time I teach the class, I try to do a little different. Some students like to know what the vocabulary are so they could focus in on the chapter readings and make that a point of a way of learning, a starting point. Remember, in this course, you're going to have a good baseline, a good foundation. Once you understand the foundation, the terminology, the concepts, a whole new language, versus it's taking on what you've learned in corporate finance and now expanding your reach to the international market from a multinational corporation's perspective, but the same logic, the same understanding, the same strategies or similar strategies could be utilized when you're doing for a small or medium or even a larger company that's considering going to international arena. That's expand its either product life cycle or a different market that it could satisfy. Okay, so let's see an overview. What's an overview? Well, let me knock these out. And remember, you have the second tier, add into it. That's how you remember. Overview. What's a multinational corporation? Multinational corporations. Identify the managerial goals. That's what we're going to learn in this chapter. We're going to find out what are the goals for a multinational organization and what kind of structures are there. What's the main goal? Any kind of corporation, but more for multinational, is to maximize shareholder wealth. And if I'm looking at shareholder wealth, my stockholders, how do I maximize it? And what you're going to find out, like any company, the management is going to be the driving force. So I have to make sure I have the proper management to make sure that the goal of a multinational organization is shareholder wealth, not personal interest. Okay? And anything. And common theories, we're going to find out justify international business. Why would we go? We're going to talk about your product life cycle. You had to change. You're going to talk about comparative worth. Not comparative worth. Comparative advantage. I was teaching an HR class for comparative worth. Comparative advantage, and common methods. To conduct international business modeling, a model for value. When I'm doing anything else, finance, a little different than accounting. Real quickly, accounting gives me the raw data, gives me data, it gives me where it's at. It's like a scale. Here's where it's at, here's the actual number. Finance is taking those numbers and how do I make the ratios better, like the productivity, or how do I make what do you call it, my return on investment better? How do I minimize my expenses? That's what finance. Now, the same thing that you're learning domestically, how do I apply that rationale globally or internationally? Okay, so now managing the multinational corporation, I'm going to talk about this real quickly. I thought I had them all turned off. Okay, managers are expected to make the decisions. Remember, you make decisions if you're looking at a multinational as a domestic. At the corporate headquarters that's looking at strategically all over the different subsidiaries in the United States. Now I'm looking at managers in multinational. They're not only looking at countries as states. Okay, they're looking at it global. So you're expanding that from a macro to a micro perspective or point of view. Okay, focus on this text is we're going to be talking about multinational MNCs whose parents fully own foreign subsidiaries. Like that, when I'm talking about the parent, it means the company started here in the U.S. or might start a European Union. We're going to, for lack of better words, I think the author says the multinational organization started domestically in the United States. Now it wants to expand globally or international. What are the strategies? How do I start going into the international market to for potential growth and also diversification, and also to another stream of income, which we learned in finance. Okay, where the U.S. parent is the sole owner, subsidiary. So basically, we're not talking about joint ventures or anything else. I'm going overseas, and the parent is also the corporation that owns the subsidiary in the foreign country. Okay, now we're going to talk about what we call about the agency problem. When I look at managers, just like anything else, we forget that we are part of a whole. In a corporation, managers, let's say if I'm a marketing, I start thinking only marketing, forget about the engineering, or I forget about the sales, or I forget about production, or I forget about my manufacturing, or if I'm in that department, it's just my world and I forget about everybody else. Easily to done. So there's problems where people are self-centered or using politics to satisfy their own agenda or to make their department grow or better. It's not really following the corporate direction. Now take that, and now if I'm looking at multinational and I'm taking this corporate entity, which we call MNC, multinational corporation, and I have a subsidiary in France. I have a subsidiary in Africa. I have subsidiaries in China. Wherever, they should be looking at satisfying the multinational strategy to satisfy the shareholders, but they may be looking at their own self-interest. Let me build my regime, my empire here, and forget about the other subsidiaries or forget about the parent or the organization as a whole, the corporate. Okay, so the same thing happened. And in that case, what we call those as agency costs or agency problems. So if I'm looking at for managers are tempted to serve their own interests instead of those of shareholders, conflict goals between firms and shareholders. Remember different firms and shareholders? I'm in here, I'm not, and the parent is U.S., I'm not concerned about that. I'm only concerned about the subsidiary where we're operating. So an agency problem exists. That's what the manager. So and a lot of times you see in a national corporation movement, the managers try to minimize that. Okay, so what are agency costs? Okay, definition. What's the definition? First of all, cost of ensuring that managers maximize shareholder wealth, and there's some costs associated, are normally higher for MNCs than a corporation, right? Because you have more exposure, you have more market, you have more ability to bring in different streams of income if properly managed. Monitoring the manager. So how do I manage her? Make sure that distant subsidiaries in foreign countries it's harder to manage. What it's basically saying, foreign subsidiary managers raised in different cultures may not follow uniform goals. That's why we cross train them. We bring them here first before we bring them back and have them managing their own hosts or their own. I mean, they have that knowledge, but I want to see a similar operation, so kind of breaks that bondage. It's like the parents aren't there, but I want them to understand the rules that I've established, and now they're on their own, and I'm still funding them. But are they still obeying and following the same rules? Okay, so may not follow uniform goals. Okay, but we'll work on that. Sheer size of large multinational can create large agency problems. Because how can I manage it? I can move people around, but I can't move them every so often. I move every 3, 4, 5 years, so not to disrupt the process. Okay, some non-U.S. managers tend to downplay short-term effects of decisions. So sometimes I might have a decision from a parent, and I'm bringing it down and say, "Oh, they're just calling wolf or something else," and they don't really mean it. We know what we're doing here. It's up there when they're making that goal. It really doesn't affect us. And that's bad, okay? All right, so we turn those off, so we have that. And now, if I'm looking at a parent control agency, now how do I control it? Parent should clearly communicate the goals, boom, for each subsidiary to ensure a manager's focus maximizing the value of the subsidiary. We're talking about value. How do I do that? Part of their goals, part of their incentives are all tied to achieving the multinational corporation goal, the corporate goals. All right. Corporate control agency problems and entire management of MNC. Okay, so I have to control the agency problems. It could be the whole management things. Must focus on maximizing shareholder wealth. We just had that. Oops, sorry. So the parent, the same thing. All look, if I'm looking at from the parent or from the corporate perspective, the whole thing, remember, is maximizing shareholders' wealth. The reason we went internationally is to improve our stock ratings, improve our stocks, improve our dividends, so our shareholders will invest in our companies. That's why we go multinational. Different markets, different opportunities, different growth potentials. But the bottom line is the shareholder says, yes, you went to China, you went to Japan, you went whatever. How much are we making? And are we as a shareholder, was this a good move, Mr. Manager? All right. Now, MNCs, multinationals experience greater agency problems just because you have different cultures, different way of looking at it, different managers. You have language. You have a lot of different things you have to manage that could create some problems more than domestic firms. Domestic, here are the laws, here are the rules. We understand it. We could manage it. We could do risk management a lot easier because we understand it better versus multinational. From the corporate, there's so many different things going, and different, and if you look at multinational organization, they may just be focusing strictly in China or in Japan or Asia or European, or some are global that have their footprint in every country, or the majority of the larger market. Okay, when you look at SOX, the Sarbanes-Oxley Act, and that's when it's taken from accounting. Accounting, because of Enron and everything else, that corporations were greedy and not looking for the shareholders or even for their employees' well-being. They took risks, and now there's laws and rules. So what happens when you look at the SOX implementations from a financial perspective, even in a global perspective, I have to show accountability. I can't say, well, I didn't realize, I didn't do the numbers. The accountant did the numbers, or my direct reports did. I'm sorry. You sign off on it, you could go to jail if you're falsifying. You have to understand the financial ramification that you're putting your shareholders in the organization in, or the opportunities, but you had to sign off. So it ensures more of a transparent process for managers. You can't hide underneath that corporate umbrella to report on productivity and financial conditions of the firm. Shareholders want to be honest. Don't play with the books. Don't use creative accounting. Be straightforward. Use the approved accounting methods. And remember, international, when you're taking accounting from last chapters, you understand that there's a momentum going forward, that as you have the acceptable accounting procedures, you can have the same acceptable international procedures that all companies internationally will follow by the same rules. Will make life easier for financial managers. But maybe easier, but it'll be a lot easier for the government to see that I'm not playing games. Right. One thing you have to look at. Government's looking at that. Okay, stocks improvement, corporate governance of MNCs. Okay, well, what are they doing? Establish a centralized database of information. Okay, so that's what it's doing. Ensuring data report consistently among subsidiaries. Everyone knows what's going on. Similar data. We're looking apples to apples. Here's our investments. Here's the same. Everyone's looking off the same dashboard or same set of financial statements or ratios that make sense. Speeding the process, all department subsidiaries have access to all the data they need to make critical financial decisions going forward. Executes more accountable for financial statements. I mean, basically, if you lied, or even the company went on there and you said, I didn't realize that, and you signed off at that as a manager, you're held responsible. You could be fined, you could do prison time for lying or for falsifying documents, okay? Forget the losing your job. There's a lot more into that. All right, so now what's the next one? Management structure of multinational organization. If I look at the structures of multinational organizations, it breaks down similar to the regular ones that you've learned in organizational management, or corporate organizations, or management. what's the structure of a corporation? It has two structures. We learned about centralized or tall organization, and then we learned about flat organization or decentralized. Remember, for introduction to business, throwing that up. We have an exhibit here. So if I'm looking at centralized, before I go into centralized, allows managers of the parent to control foreign subsidiaries, therefore it reduces the power of subsidiary. So what's happening in the centralized, here's the parent, all the decisions are made from the corporate. It's a centralized. Every also subsidiary, you got to listen to them. You have nothing. All the major decisions comes from the central from the parent, financial manager. The cash manager, subsidiary A, and the cash from subsidiary B has to get his approval from here. They can't make it on their own. Inventory, everything else from two comes from here. They're controlling it. Financing subsidiary A, capital expenditures for this is just two different countries. Some countries have multiple. We're just doing real simple. It's all centralized. Every decision is made at the central office. You're just an extension, but you have to report. It's like a child going out there, living someplace else, but all the bills, all the decisions are made from your parent at home, real quickly. All right? So that's centralized. Now, that has some advantages. There's some, I could keep consistency. I could keep control of my costs, my inventory. I know what's going on. Now, decentralized works a little differently. Subsidiary A and subsidiary B are two separate entities, business units that report to the centralized, but they're decentralized. So the cash management, inventory, all controlled by subsidiary A and subsidiary B, and the corporate is up here. They may give them the guidelines, or here's what we want, but you're basically separate units here. I could spin them off, I could sell them off. This gives me some, when we talk about it later on, this gives me some flexibility because it's I'm closer to the customer. I can respond quicker than going to the corporate that may not be in tune with what's going on in that region. All right, gives more control to subsidiary managers who are closer to the subsidiary operation and environment. Make sense? Okay, now you get the internet. When I look at the internet for either centralized or decentralized, it gives me a new tool that instantly I could get data. Boom, through the internet. Facilitates management control. Makes it easier for the parent to monitor the actions and performance of its subsidiaries. Very simple. All right? All right, now we go. Well, it looks like it's easy. We have a lot on this side, okay? All right. Oops, it popped up. Now, why firms pursue international business? Why would you want to go internationally? It's going to cost me money. You're going to have to set up. Remember, for this course you're taking me, you're going to be, as a team, developing a multinational strategy. You're going to be either a brand new company, domestic company that's going to open up a subsidiary someplace, and you're going to see what's the cost ramifications. So every chapter that you're reading has, at the end of the chapter, the author has a chapter that says multinational corporation, you managing it, and so you're going to find out every chapter, how do I add into it for my domestic. That's how you're going to learn. Don't worry about too much of the numbers. I mean, you're going to come up with some dollars and everything else. I want you strategically to think of it. Once I come up strategically, then I understand this makes sense. And now if it makes sense, is it sustainable? Is it profitable? Is it a good investment in return on the shareholders' capital that they're letting me utilize or that I'm managing for them? So why would companies do it? Okay, let's look at this. Now this is a little bit different one. There's three international businesses justified by three theories. You have the comparative advantage theory, you have the imperfect market theory, and you have the product cycle theory. These are all theories. We've had them in different cases. You've already had them in management. You've had them in introduction to business. I know if you had a little bit in finance, you've been exposed to this, the comparative advantage. What is a comparative advantage? The comparative advantage, let me just get back here. Moving it over. The comparative advantage suggesting that specialization by countries or country can increase worldwide production, rely on other countries to meet their needs. All it's telling me is build what I do best and buy from other countries what they do better. I like to do it all, but if they're doing it better at a lower cost and giving me the same quality, I'll buy from there and find out what my niche, what my specialty is. What do I make the best? And some countries may not. I'm just saying, this is just the theory why I'm going out. So I'm building something, and I know I'm doing it the best. And I know there's other countries that may do a similar product or similar operation, but I do it better than them. So to them, it makes sense to outsource me to do that aspect. And even with my rates and everything else that I'm charging them, they still make a profit because I'm doing it more effectively and efficiently than they could do it themselves. Okay, so that's why I'm expanding. I've got something. I've got the golden grail. I've got the key. I know how to make this thing work. Okay, now in perfect market, when I look at imperfect market, condition where due to cost to transfer labor and other resources used for production, remember factors of production, capital, labor, infrastructures, knowledge, when they are less costly than local factors. Encourage countries to specialize based on resources they have. When I look at factors of production, are somewhat immobile. I can't move all the people from Africa, and because that's the new manufacturing section. We're going there. People are going to Africa. Chinese, their quality of life and cost of living and everything else is getting more expensive as their their economic system is growing. People want more. They expect more pay, and so now the cost of doing business in China, with the regulations and everything else and pollution, whatever they have, is increasing. So now manufacturers are looking for a lower labor intense country that would be more to minimize their expense on labor. But when you look at factor of productions, I can't move everyone from Africa or everyone from China into my facilities. They're immobile. Doesn't make sense. So it's not it's an imperfect market. So even though I'm there, I may have to do some adjustments. But I have to look what's the cost for either bringing in some part or training that. This also is a cost. Remember, in finance, we're looking at yield, how much everything costs afterward, and we're looking at terms and conditions. What are terms and conditions? The terms and conditions, and we're looking for the long term and short term. Usually for long term, my terms and conditions may not be as profitable early in the stage, but over the long term, I have a solid base, and long term, it's a good return on my investment. But it's an imperfect market. So I had to make some adjustments in the countries if I'm going to open up or do international business in that country. All right. So, or my own country, I may be, imperfect market. I don't have all the labor. I don't have something. I got to go overseas. Maybe supply, maybe inventory. It just makes sense to open up the operation there, closer to the source where it's coming, other than shipping it here and working it there. I minimize the distribution change and how much savings that I get. Okay, now product cycle theory. That's kind of, and they've got an exhibit here. If I look at the product cycle theory in a nut, let me just go over here. And I'll just throw this out here. I have it all, so we can see it in one large. Move it this way. If I look at a product, firm creates a product, accommodate to local demand. That's why I basically start off. Mostly, remember, I always told people, you're thinking locally. You're working locally, but thinking globally. Okay, I made it locally. I saturated the market. Domestic, I beat all the one state. I went to the other states. I've saturated in the United States. So now, what can I sell this someplace else? Firm exports product to accommodate foreign demand. There's a need for it outside. Firm establishes forms subsidiary to establish presence in a foreign country and possibly to reduce costs. Possibly. Sometimes we do it because it may be an embargo, or sometimes we do it politically makes sense. All right, but a lot of times it's to reduce the cost. Or okay, so now I have this. Now here's the two paths for firm. The products are different from competitors, or expands product line in another foreign country. That's why I'm doing this. I'm over here. You'll establish is why I would establish a foreign subsidiary. Firms' businesses declines as competitive advantages are eliminated. Foreign business decline. So there's two different things happen. Why would I go to another country? Even in my own country that I have under the subsidiary, I may have more competition, so I may move to another place. Real easy, okay? In that country, I saturated again, so now I have to move again. I'm still keeping a presence there, but I'm slowing it down, or maybe my cost is getting higher, so maybe I'll go to another country and just ship something back in there. How much is it going to cost me? Everything that's just strategically done is a cost associated. Do I buy a car? Do I lease a car? Do I move? Buy a house or a rent? You're doing that every day. Now think of an organization from a financial perspective. Accounting gives me the numbers. Here's how much we're costing. What makes sense to reduce my expenses and improve my shareholders' wealth? Okay? Okay, so a firm initially establishes itself locally, markets response to foreign demand, growth potential over time, it can expand. The MNC will grow in foreign markets unless it's differentiated. It's different, its products from competitors. At some point, its foreign business may decline. All right? Sometimes I slur some of the words. I've been recording, so we're doing fine. All right. Remember, English is a second language for me, so sometimes I may pronounce the word a little bit differently, but they're spelled correctly and they're right. Okay, how firms engage in international business. Now, this is a repeat. I'll just close these all off. You already had these. I'm just going to go real quickly on this. You already had all these when we did Introduction to Business. Was a required class for accounting. It was a required class for finance. And since you had finance, I already know you've had these classes, especially at the community college that I'm teaching. I think it's at Harper, the same thing at College of Lake County. In the finance, you have a certain progression that you have a good base understanding. Remember, so you have a good understanding. So now you understand already. You've been exposed to licensing, franchising, joint ventures, acquisitions of existing operations, establishing new foreign subsidiaries, and summary method. So let's look at international trade real quickly. Just give you a quick overview on this. Conservative approach, international trade, very conservative, used by firms, penetrate markets by just exporting. We've got an exporting department. Obtain supply at low cost by importing. Small business, medium business, all business. You import, export, what makes sense. Minimal risk, no capital at risk. And here I use the internet. Facilitates international trade, accepts orders on their website, small business, real easy. MasterCard, Visa, they do all the transactions with the currency, so that makes my life easier with the exchange rate. And my problem is, how do I ship it there, following all the rules and the landing requirements to the host country that I'm going to. So, but the internet makes it easier. We're on a finance management here, so financial makes it easier doing the internet, allowing firms to advertise their products overseas in the different languages. The websites they convert everything for it. So from small, medium to large, even small and medium, this makes sense. I import or export, depending on what I buy the products or sell my products, whichever one makes financial sense for me. Okay, licensing obligates the firm to do what? Licensing agreement. Firm to provide its technology, copyrights, patents, trademarks, or trade names in exchange for fees or some other specific benefit. A little different than franchising, okay? This is just some license agreement. Coca-Cola, you could license this shirt, you could license this Starbucks, you've got a license agreement made to sell the Starbucks or everything else, use my logo, my brand, and hopefully it's the Starbucks coffee that's in there, so everything else is the same. It obligates me, but I have a license agreement. It allows firms to what? Allows firms to use their technology in foreign markets. It's still safer, still kind of safe, without major investments and without transportation costs that results from exporting. Remember, because the subsidiaries there, I license it, I license them to give my name exposure. Sometimes that makes sense. I license gets exposure. If that licensing is working well, I may at that time come in there and open up my own open up a shop or open a subsidiary there. Just like a feeler. How do I start? Remember? International trade. How do I start? Importing and exporting. Now I got a relationship. Maybe I'll license it to this supplier or to this buyer. I already got their relationship. I'm taking the next leap. I went there. I visit. Now I'm looking around. I'm going to stay longer. I may come back. I may have different opportunities. Do you see how finance strategic is going? That's what I want you to think. And each cost, how much is it going to cost me? Sometimes I may lose money, but I don't want to lose too much money. I say in the short term, I got to pay the down payment, but in about 6 months, my payback can be so much, or in or in a year or 2 years once I develop in there, or I see potential in that market. All right. So I use licensing. Major disadvantage: difficult to ensure quality control. They got my license and it doesn't taste like Starbucks because they minimized it. It's okay if you have a subsidiary or you have somebody there that can watch it. A lot of times you may not know before it's too late. And control foreign processes. Okay. The next one is franchising. In franchising, let's say obligates the firm to provide specialized sales and service strategy to the franchisee. Remember, franchisor, the corporate or parent. Franchisee is the employee, the person who's paying the franchisor. Support the system in exchange for periodic fees, what they call royalties, for lack of better words. Okay, allows penetration. Remember why? In foreign markets, while major investments in foreign countries. When you learn from the franchising concept, I want to be a franchisee, I have to pay so much money. Most franchisees have to secure the land, have to pay for the building, do everything else. Just have the name. Sometimes in a foreign investment, I may help the franchisee to secure the land because I want to see, is that a market I want to open up before I go a full bolt out there, or how many McDonald's I want to open up at once. I'll let somebody out there try it. Once I see that they're successful and that franchisees open up another franchise and ask for another franchise, then I may bring in the corporate into that as a subsidiary. Still keep them there because they started off, but then the risks are there. My name has been exposed. It's like they've opened up and they've welcomed here. Oh, they've been, remember, international. McDonald's is known in the U.S. A lot of people from China travel there. Now, they say, I kind of have a taste for Big Mac. That's one thing I like there. Even though it's not there, they've got accustomed to it. So now they've got the name. We've got a following internationally, or you see on the TV, the web, you see it out there. What does it taste like? So you will have a name, and you have somebody else that's going to start it, and then you're going to pick up from a franchise agreement, which is pretty good. So how much you want to pay? Usually you don't pay for that, but because they're international and you want to try it out, I don't take the risk, so you're splitting the risk with the franchisee. Okay. Now, joint ventures. A venture that is jointly owned and operated by two or more firms may enter the foreign market by engaging a joint venture with firms that reside in the market. So I want to go into a market, and sometimes it's hard for me because no name recognition or the distribution channel. I'm not sure it's going to work, so I do a partnership. And you see a lot of car dealers do a lot of partnerships with let's see, Honda or Toyota or everything else. There's a car because people wanted the small cars, and the U.S. was in the making small, dependable cars. They are now because a lot of things, but at that time they weren't. So they had a joint venture working together. So and so they would come into our market. We already had the distribution, the name recognition. So it was real easy. They just had to have. We were selling another product line. Okay, so what are the advantage? Allows two firms to apply the respective cooperative advantages in a given product. Remember, so now I've got the money, or I've got the car, I got the distribution, I got the channel, I understand the market, I know the marketing. So now we're taking both of ours and we're coming together. It's like a marriage, right? Joint venture. We're coming together and we're going to do this to see if it works out in this area. We still may have independent or different joint ventures with different competitors, but in this region, we're doing a joint venture because it's an advantage not only to the organization, but to maximize shareholders' wealth. I keep on stressing that, okay? Now, the other one is acquisition of existing operation. In this case, what you're basically doing is your acquisition of firms in foreign countries. The company's already there. It's like I'm buying an existing business, for lack of a better word. Allow firms to have full control on the new ownership. And if you look, a lot of companies here in the U.S., they still maintain the U.S. name, but they're governed by a multinational organization or by someone outside, or foreign investment, or foreign stockholders outside that own the company now. Okay, subject to the risk. You wouldn't know it because they keep the name. It makes sense. It's got brand name. You got copyrights, laws. Let's keep it. Who's the owner? Who's pulling the strings? Who's funding it? Who's helping it grow? Okay, subject to risk of large losses because of large investments. I'm buying this whole operation, maybe with the employees, maybe the laws. I mean, I know it's, I'm taking a larger risk instead of just starting off small, like importing or exporting, or a franchising or licensing. Now I'm jumping right into a joint ventures of marriage, so we both have something to lose, but we're both coming in with our assets. This one, I'm picking it up all by myself. Okay. So subject to, I'm buying the operation, just makes sense. I want to, I'm Coca-Cola, I'm just going to buy the bottling company, and then bottle my Coke, and the distribution is already there. But I got to take the workers and everything else, how it's the infrastructure, how it is how I take it. So there's a risk. There's a bigger cost. Okay, liquidation. May be difficult if foreign subsidiaries performs poorly. How do I liquidate the asset? What are the laws of that asset? Do they have a bankruptcy? Do they have something else? What happens? Could I just leave? Just some countries, some companies are stuck where they have, because of the laws, that they can't fire or lay off, even if the company is struggling. There's no way you can lay off anyone. You still have to pay them. So what do? I just belly up or go up? But those are constraints. Those are the rules that I agreed to, which may not be favorable for me now. So be careful. Okay, now establishing. Okay, I went with this. Okay, establishing new foreign subsidiary. Now I'm going to go cold turkey. I just want to open up my own business. I can control it. I'll bring in the people. I know the laws. I know I'll start small and I'll grow. That's the strategy. Remember, but how much is it going to cost you? Each one of these are options. And each one of these in finance, you're going to come up with a dollar amount. How much is international trade? Importing, what's it going to cost me? How much is for licensing? Okay, how much return do I get? How much franchise? How much return? The bottom line, how much return I'm going to the corporation? What's helping my bottom line? What's helping my profitability? What's bringing my the shareholders' wealth, increasing it. Okay, so now I could penetrate by markets by establishing new operations in foreign countries. Requires large investments, something like in here too, but it's all new. I can control it. Acquiring new proposals to existing, buy new or buy it used. There's there's advantages. Allows operation to be tailored exactly to the firm's needs. May require smaller investments than buying an existing firm. Because here I got to buy the labor, everything else. I could start off small and go larger. There, if it's already large, I got to wind it down and then expand it. May be not cost effective. Depends on the time frame. Or if I'm buying just one section, selling off the other. That's all dollars. Remember, these are all dollars. How much is it going to cost me to here, and what's my return on investment? Okay. Now, summary methods. If I look at summary methods, they're basically look at the direct foreign investment, DFI. Any methods of increasing international business that requires direct investments in a foreign operation. It means I'm actually opening up a plant, I'm putting something there, some capital, some structure, something that's, I'm going to stay there now. International trade and license usually does not include that. Remember, I don't have to do any kind of investment. I just trade back in license. I don't have to put a foot. I don't have to spend any money on there. If it doesn't work, I just don't trade with them anymore. Or you know what I'm talking about? So it's real easy. Import. I just find another place to import. I just lose that customer or I lose that supplier, but I can find another one. I have nothing there. It's like I'm on vacation. I like it. I go home. Or I'm just renting a condo. I'm renting a spot. Okay. Now, largest portion of direct foreign investment is foreign acquisitions. Right here, I pick it up, and establishment of new foreign subsidiary. That's the largest cost. So when you're doing that, you have to make sure. And for me to spend all that money, I'm looking at potential growth in the market. Why are people spending all the money in China? Why are people spending all the money in India? The potential of the market expanding return once I'm in there, understanding it, learning it, get to understand the rules, get to understand, train my managers that we talked before, and now I could start expanding because the market, as it grows, I'm already there. Easier for me to expand instead of catching up. Okay, now summary methods and the cash flow diagram. Let's look at this one. I'm going to go cash flow diagram, and I'll talk about them a little bit. International trade. So we have an exhibit. How does money come and go? Okay, multinational corporation, okay, from exporting, importing. That's all I'm doing. A large corporation, foreign, cash comes in, foreign importers comes in, outflows to my exporters. in and out, real easy. Importers, and then exporters. Okay. Now, licensing, financing joint ventures by MNCs, multinational corporation. Okay, foreign firms or government agencies. Here, cash inflows from them, the service I'm providing here, and then cash outflows for services received. So it's coming in here, coming back, and the service receives, I go back. I got to pay them something. Investments in form subsidiaries by multinational corporations. Okay, so now I'm going in investments, direct investments, cash flows, cash inflows from remitted earnings by subsidiary. I own it. Everything else, they're paying the rent. After they paid everything else, I got profitability. Now it's time, depending on the exchange rate, depending on everything else, I bring the money back to the parent. Now, cash flows to finance operation. So money's coming back, but I still got to feed them. I got to keep the operation going. I'm control. Even though it's maybe self-sustained from within that global, but it's still money. All the money comes back here. I'm just reallocating the money back into my subsidiary. So that's my exhibit. So when I'm looking at it, I have international trade. That was the first one that we talked about. International arrangements, right? And this is my concept map. My expenses below incurred from transform technology, funding partial investment, or in franchise or in joint venture. Outflows. Inflows are receipts for fees, or in this case, if it's a franchise, it would be royalties or or if it be licenses, anything coming in. That's why it's open like that. International trade basically is just imports and exports. In direct foreign investments, cash flows between the parent company and the foreign subsidiary. Real easy. Remember, like it or not, you have to understand the money. Where does the money go? You have to understand the cash flow. Okay, so now the next two areas we're going to be talking about is valuation model of an MNC. What is the value of an MNC? What is my owner's equity, for lack of better words, as I bring in another subsidiary, as I open up another venture, as I buy property? How much does this property cost? How much did it add into the value of the multinational? Remember, not the subsidiary. Maybe the value, a lot of value here, but when I bring it into the corporate, it may bring my earnings down or may bring it up because I'm spending too much money. The return of investment in that country right now may not be what's an acceptable return on investment for a multinational corporation, but you factor into the fact that it's starting off when in 5 years I'm going to double that investment. Investor says, okay, let's take the gamble. Remember, you got to plant the seed like a farmer. It's not going to come overnight. I got to plant the seed. Once it grows and it grows, I understand how to grow. I understand how to fertilize it. I understand the process. And now I minimized everything else right to the efficiency. I know ship it, get it right away. That's what you call understand the logistics. So now I understand my yield. Now I understand my yield. I can start growing. All right, and that growth brings a value to my multinational corporation. So let's see how we're going to do it. We're going to talk about the valuation model, MNC, just real general. MNC's value is favorably affected or negatively. How is it effective? Remember, you have to read the book. Read it slowly. It's not that hard. The first chapter, maybe 20 pages. Easy reading. Not easy. A lot of information, small print. A lot of information. Get the good foundation. This is a good foundation. And then as we start building on the other chapters, you'll understand strategically what we're doing. Okay, value is favorably effective when it's expected foreign cash inflows increase. That means money's coming in at an increase. I'm not losing money. Currencies denominating those cash flows increase. So when I do the transfer, the denominations are increasing, or the MNC's required rate of return decreases. All right. So my rate of return decreases, but my return investment increases. All right, or cash increases. Okay, now the negative part is this: value is adversely affected when its expected foreign cash flows decreases. Makes sense. My foreign cash. Wait a minute. I'm not making. I'm breaking even. I expect that. Remember, we're going to talk about the environment, what's going on, the factors. But is it short term or long term? If I think it's long term, do I get rid of it? What do I do? Remember, mine is to minimize it and move forward. And how do I do this? Even though you have to still looking at the dollar amount. If I'm bleeding the corporate to keep something alive because of some agency problem, because the manager doesn't want to turn it down because he doesn't want to move to another country, you better make sure those numbers, why are we keeping this? It's non-profitable, let's cut it loose. Or it's so profitable, we need money. Another thing, what could we sell? Because this other thing could have more profitability going forward. Okay, values diversity negatified. Okay, the values of currency denominating those values decrease, assuming that they have net cash inflows in foreign countries. Some of them may not. They may just keep the money there. The MNC's required rate of return increases. All right? It's a little confusing now. It'll make sense as we go forward. Just bear with me in this first chapter. We're just learning concept. We're learning the different things. We're learning that everything else that we're going to do in a multinational, we do internationally, in international finance, it has to add value to the business. Has to add value to something. If there's no value add, it could be goodwill, and there's a cost associated, but it has to have some value to the shareholders. Otherwise, I'm a poor manager. Okay, so let's look at the domestic model. Here's the formula. Now I have V equals represents the value expected cash flow. I'm going to leave this formula because we're going to go through it. The book, the author has an example that follows along, which will make it easier to understand. I'm underneath an hour. I'm already running over. I want to keep underneath an hour. So let's look at the formula. V equals represents the value of expected cash returns. E, parentheses, is expected cash flows received to the end of the period of time. Expected cash flows. I should make this, sorry. Let me just do this right while I'm here. And let me do it here. Let's make it bold. Okay? I just want to make sure. I thought I had it bold. Expected cash flow. Those of you who are looking at this, it helps you. Remember when I have it in bold, so you know it means it's something important. I just forgot to do it. Okay, expected cash flows to be received at the end of a period. And if I'm looking at a period, which is T. Forgot to make that bold. Nah, we're alive here, right? So you got me. We're alive, okay? So that's the formula. N equals, remember, in our finance, N is always, even when you look at your financial calculator, represent the number of periods to which into the future in which cash flow is received. And K represents the required rate of return by investors. It's a little bit different from the other formula because this one's going on up. It's K, that you've learned in corporate finance. Okay, so now that's domestic formula. So if I look at the formula, here's how the formula is written, right? You got the V, cash flows, right? The value. Here's the summation, right? So I've got the T, right? The time, number. You've got right here the expected cash flow, right? Here's the formula. The dollars, right? And the time. And then 1 minus K, which is the return on investments. And then times T. Look, I'm not going to, the calculator do it, you're scientific. I'm just showing you a formula where the parts are. Take your time, look at it, read it, follow the formula, you'll understand it. When you're going to be tested on this course, it's an introduction to international finance, I will let you have some cheat sheets for the formula. There's no way you're going to remember all of the formulas. I use everything else for a calculator or a spreadsheet, all right? I mean, if you do it every day, you'll remember them, but most formulas are there. I just want you to understand, if you have to solve it, how do I solve it? All right, now dollars is the T. Okay, so dollars cash flow. So we're in here. The dollars times cash flow in period time. That's what this one is here. Represent funds received by the firms. Minus funds needed to pay the expenses. Remember, when I'm looking at these dollars, after I get rid of all the expenses, pay the expenses, I'm looking at the net, not the gross. Okay, or taxes to reinvest in the firm. Okay, minus these two. That's where I get my T. All right, my dollar cash flow, the dollar sign. Doo-doo. All right, now cost of capital. Cost of capital is my K. Required rate of return. I'm just expand a little bit on here. You know, I could probably put that in here. Rate of return by investors. It would be easier for you to understand this. I'll do it this way. I'll do it that way. I'll leave it this way. I think it'll be easier. I'm trying to do how I as a student will learn it. Let's leave it this way, okay? So dollar cash flow, cost of capital against here, we talked about here. It just gives me a little bit more. I could have put it in there, but let's leave it this way. Is the denominator of valuation of the equation. If I look at the equation, right, decay is a denominator, right? Weighted average of the cost of the capital based on all of the firm's projects, not just one, all of them. Okay? Easy? Oh, George, Dr. George, you're doing fine. All right, now multinational model. Again, here's the formula. It's the same formula. If you look at it's a little different, not the same. Right? What do? We just moved it around the value, right? But I'm looking at the expected, right? The E, the expected. Okay, if I look at the CF, the dollars and the time, amount of cash flow, CF cash flow, right? Let's do this here I'll make it real easy, right? It's kind of good I'm doing this with you so you can understand. Cash flow, all right? In a particular foreign currency. Now we're looking at J. J is basically in their foreign currency. I don't know, where is that? Oh, here it is. I'm sorry. We'll look at here summation of all of them. My error. Okay, so here I'm J, okay, because this one is the one I had here. Remember, I put it in here, but now I'm doing the summation. So I've got the J is in the currency at the end of a period. Now, if I look at SJT, and this is the exchange rate. Remember, the exchange rate is what we're adding on the formula to what you've done before in your finance. And I'm adding on the exchange rate when I'm doing the conversion. Everything else I have to exchange. What's the dollars? What's the currency worth in my currency, the parent currency? Okay? So if I look at measured in dollars per unit of foreign currency can be converted to dollars at the end of the period T. Remember, I keep it in there, I convert it. Now, do I pull it back? There's another whole strategy we're going to talk about. When do I pull it back to the parent? Maybe right now the taxes are high or it's safer off leaving it there. Because once I bring it back, I may have to pay taxes there. There's new laws going on where you see a lot of companies leaving the U.S. and setting up their operations overseas just because of the inversion laws coming in here, how to tax incorporation or multinational organization. But a lot of still American companies are still staying there. They say, hey, this is still good. We'll pay our fair share up to a point. Okay. Now, when the multinational uses two currencies, what's the formula? Again, you had the same formula that you had here. There wasn't nothing else. You just here. Let me explain that. Same formula. What do? Let me just do it for my visual individuals. Okay, derived an expected dollar cash flow value for each currency, and then you just combine the cash flows among the currencies within a given period. So I'm looking at when I'm using two currencies, that means I'm using it at two different countries. Or I may have two, let's leave it that way for now. Two different countries, two different currencies because they're bordering each other. Let's say China and India, and I got an operation that borders both at the border, that import from one or export for one. Just makes sense just where it's located. Okay? Valuation of MNC that measures expected dollar cash flow any two period uses two currencies. One, by multiplying the expected cash flow in each currency. That's what you're doing. Remember? In here, when I'm in here, cash flow, particular currency. So we have that. By the expected exchange rate, that's where we have in here the exchange rate, correct? SJT, right? By the exchange rate per currency times the time when I'm ready. Remember, the exchange rate doesn't make any difference till I'm doing it because the exchange rate fluctuates. It could be daily, it could be by the minute. If you're looking, because some people have programs, a lot of banks have programs just by the few seconds that it fluctuates, they can make some money if they're selling or mostly when they're selling the currency. Or when do I buy it? They're selling, someone is buying it because it's lower and the price is going up, the exchange rate. All right, so multiply by expectancy exchange rate, which currency would be converted into dollars, and summing those two products. Now, the next one you have in here is multinationals cash flow multiple periods. Now, here's the same. Here's a formula. Here's the formula valuation. But because I have different periods, I'm looking at my cash flow. Cash flow is to make sure I have money on time, not only from the corporate but also the subsidiary. When does the money? Because remember, anything else, I'm looking at my credit worthiness. I have to have cash. I have to have it there. Otherwise, it has a domino effect that could be negative to the organization in our credit rating. Okay, valuation of cash flows. And how much is that cash flowing? When's it flowing? There's a dollar amount. I want it to flow when it's low, and the exchange rate when it goes up, or vice versa. What makes sense for my business, my operation? Remember, finance is looking at it to set it up that it maximizes everything. Same thing like finances in a corporate and a domestic. Now I'm looking globally. Which areas are I'm losing here, but I'm making more money? Do I switch money here? Do I slow down this process? What makes sense? Or do I sell this unit? Or do I prop it up because I know it's going to be in another year it's going to be a success, but I got to just wait out that time period. All right. So here's the formula. Now, apply a single period process to all future. Discount the estimated dollar cash flow for each period of the weighted average. Remember? So I just discount it on the weighted average, and I just change it, and we should be fine. In the weighted average, different time period would be the time that would be different. Okay? Let me leave that open here because I got my formulas. You see they're pretty close. Following along, here's the value, the summation. And now I'm just going with the time on here because I got multiple periods. Remember that's where K was at? Where are we at? K, rate of return, time with the T. Sorry. Multiple periods, okay? All right. Now, so we have everything. Look, we got the formulas. You'll solve them. It makes a little sense when I have the example. Maybe next time, if some of them might have an example to follow it through. I'm doing the first chapter. I just want you to get through this. It's the hardest chapter. Now you understand. Your mindset will work out well. Okay, now if I'm looking at this one, uncertainty of multinational corporation to cash flow. There's an uncertainty of a cash flow. Summary of the international effect. What the heck does that mean? Exhibit 1. When I'm looking, here's the formula. Uncertain foreign currency cash flow due to uncertain foreign economic and political condition. Here's my uncertainty cash flow. Uncertainty surrounding the future exchange rate. Here's the uncertainty. All right, so I've got my formula. Okay, uncertainty surrounds the valuation. Exposure to foreign economics. And here's the formula, greater than, all right, it goes down. And exposure to the risk, and exposure to the rate risk. Now, that's your summary. So international conditions. What are the international conditions that could affect this? When I'm looking at economic conditions in foreign currencies weaken. Purchase of products decline. MNCs, multinational corporation sales in that country may be lower. So here's what happens. Weak European economy. Reduced European demand. Reduces European demand for U.S. firms. Anything else? Reduce the sales of U.S. Cash flows to U.S. firms. Reduce the value of U.S. firms. Okay, weak U.S. dollar. Weak U.S. demand for products at U.S. firms. Weak U.S. economy. All this is what could affect my economic condition that I have to be aware, and why my value goes down, down, down. I got to be political. All my value keeps on going down. What do I do? Is it short term? Is it long term? Long term, do I sell, take a hit, and walk out? I mean, remember, I take a hit, I'm losing to that country, I'm destabilizing, but if the country's already destabilized, just cut my losses and get out of here. Or do I start shipping operations? Or I know something's going on ahead of time when I make the changes. Or do I ride it through? Because I figure I could survive the storm. Let me leave that open. Okay, exposure to international political risk. A foreign government may increase taxes, so it's going to throw off my whole evaluation. So it may not be as profitable now, but then the value of that subsidiary is decreased because I got to pay more taxes. I pay more taxes. That means it reduces my profitability. It's another increase in my expense, unless I can raise the cost or something else. Because if they increase my taxes, I'd increase in the taxes of my customers or constituents that are in that host country. If they increase their taxes, it also means that my product they may not be able to afford, or because they have a cash flow problem. Okay. And then exposure at the risk of the exchange. If the foreign currency related to the MNC subsidiary weaken against the U.S. dollar, MNC will receive a lower amount of dollar cash flow than was expected. So I'm figuring I'm going to convert this, and it's my yield. I'm going to get so much dollars. But by the time I turned it in and I paid off everything else, the exchange rate, because the dollar was weakened against the U.S. dollar strong, so I didn't get as many dollars back when I converted it. I got less dollars, you know what I mean, for my asset. So I had to make up a shortfall someplace. Remember, finance in the multinational is very important because all these other companies, I'm looking at the bottom end, coming back to the parent company. What do I have? That's what the managers are, or the parent company or corporate managers are looking at. How are we, the shareholders, we invest in this organization because you're multinational, you're multi-corporation, you are diversified, and your portfolio, your return on your assets or my investments or the growth of your stock increases because of this diversification. But make sure if I start seeing it decreasing because of poor management, I want out of there. So you as a finance have to make sure, so I sold this operation here, it's going to have an effect there, but globally for the corporate, is it a positive move? Okay, I'm trying to reduce those. I have that. And then what's the last one I have on there? Uncertainty affects multinational corporations' cost of capital. Higher level uncertainty increases. Return on investment required by investors. The MNC valuation decreases. Because I got to pay more, so my value decreases. It's worth less. When I look at valuation, I'm not looking at that one subsidiary. I'm looking at the corporate, the whole. All these pieces, all these subsidiaries come into one. Even though if it's decentralized, somebody's owning it here. It's underneath some corporate. It just depends on the management, how much latitude or control they have of their operation, whether centralized or decentralized. Otherwise, a lot of the subsidiaries you find makes more sense to be a little decentralized, flatter, because they can respond quicker to the market as it needs. All right, so we have that. Not too bad. Look, read the book. The book is good. The formulas aren't that bad. You'll understand the formulas. Remember the formulas. I'll let you have cheat notes or notes doing the formulas. Because right now, if I'd be doing in the business world, what would I be doing? I would be using a spreadsheet and getting that done. Okay, so let's look at the organization of the text. We're done with the valuation. Going forward, look, the numbers are there. The formulas are there. You'll be able to utilize your calculator. You'll be able to utilize that. That's what I want. There's no way you're going to do this in the 16-week course or 8-week course on an online learning all this. If you understand what's going on strategically in finance and know the terms and conditions, how to explain it in my own words, you won't have any problem when you're looking at putting in the formulas and using, what some of you already know. You know what T is, you know what the dollar sign is, you know what the interest rates are, the K is the return on investment. So you already have some of the symbols. Now you're just going to put the exchange rate in there and something else and some other factors that's going to look at the environment, and then you should be all right. But you should be always thinking of that. When you see the environment or the political structure going down in your mind, you know you're going to lose money, or they're talking about taxes. I'm going to somehow, I got to pay something. How do I make my move, or how do I minimize the effect of something on my operation, on my financial well-being, is what international finance is, similar to domestic finance, is the terms and condition and how do I maximize shareholders' wealth. You want to go down. Even though, remember, the product life cycle, you're going to have some ups and downs. That's normal, but they want to see morally going steady up. If it drops down, maybe flat, but how do you go down? Drops down, how long before you pick it up? Otherwise, investors are leaving you, or they're replacing the management team, or are you going to get a new CFO, chief financial officer replacement? Okay, so let's look at the book. Here's how this book is broken down, and I have it in here, and here's the graph. You're going to go background information, financial markets, chapter 2 and 5. That's what you're doing now. From chapter 1, it's just a quick overview. Chapter 2, we're going to talk about different markets. It'll be a little more fine-tuned, easier for you to understand. A few concepts, I gotta say, new vocabulary, new strategy for each one. Okay, so 2 and 5. Now you gotta go 6 to 8. Exchange rate behavior. You can see the fluctuation of exchange rates. Exchange rate risk management is 9 to 12. How do I? All risk management is how do I minimize my costs and maximize my profit dollars. Okay, long-term investments, chapter 13 to 18. Financial decisions, how are we going to make long-term? Again, there's going to be some financial formulas. Risk and return of the MNCs, value and stock price of the MNCs, and then short-term investments decisions, 19 to 20. So this is how the book is broken down. So chapters 2 to 8 discuss international markets, conditions from macroeconomic perspective, large, big, that can affect the value of the MNC. Always look at the value. What's the value? Because people aren't buying companies or investing in companies that the value is going down. I'm investing it instead of putting it in a CD, instead of bonds. I'm buying stocks. I'm doing something because I think my dollar, my investment, an individual investor, is going to increase. How do I bring that out? Because people are looking at the my annual reports and following the numbers that the value of the multinational, the brand name, is going up. If I look at General Electric, it's going up. Why? Because it's into a lot of electronics. It's selling something. I think they're doing something else larger with the airplane, with some of the engines. So their value is shooting up in the stock just recently. But it's something that it's the whole image, the whole brand is affected by one aspect that they're doing is affecting the total. Some other areas they're kind of shaky, they want to get out of, but other areas that they're bringing in, overall as an investor, you're doing fine. I understand there's some areas I'm watching that are questionable, but that's just part of the life cycle. Okay. Chapter 9 to 21 is going to take the micro, the smaller, looking at the country specifically, or the manufacturing, or the subsidiary. How is he at that subsidiary operating within that host country? Focus on financial management of an MNC can affect its value. That kind of makes sense. All right, so we made the first chapter. What do you think? Chapter 1, a little overview, a little bit math, a little bit things, easy. Look, once you do this, I think we're doing like 2 chapters a week, if I ain't mistaken. So chapter 1, get your mindset. Same thing if you're taking an English class, get your mindset. I always say, take your accounting, take your finance, get all your math out of your way, then get all your English out of your way, and get all your subject matter away. Don't wait till the last minute. A lot of people are taking this class as a supplement because you're going to finance, that's your degree, or you're going to accounting, and anything you're taking, even if you're taking marketing or management, I teach those classes also, you should have some international component. The authors and all the disciplines has an international component, but you should have someplace on your resume, someplace on your, even on your transcript. I've had some international classes, international marketing, international finance, international management, the classes I teach. So I kind of throw those in. All right? Are we good? So we had an overview. You had a little vocabulary. It tied in from what you had from your corporate finance. If you didn't do well, you already have the basic. So let's just build on what you know. And it's gonna, some of it's gonna be confusing. Some of it's gonna reinforce what you already know. Other stuff, it'll just make it better. But then you keep on taking more classes, other chapter. By the time you get out of here, you'll have a good basic understanding. Remember, don't worry about the formulas. You'll be able to solve the formulas once you know the key. That's not the hard. The hard part is understanding the strategy. Why is something done? Why are they doing it? And why they're doing it is going to cost me. I have to have the cost. If I'm going to bring in another employee, it's going to cost me. Why do I want to bring another employee? I'm just bringing basically finance. I bring this employee, but it's going to improve productivity by 20%, which will improve my profitability. It might be 2% or 10%, but it's an increase overall. This is going to come in the expense side, but overall, after I pay anything else, I could see growth, or I could see a new market. But I have to always, how much is going to cost me? How much is going to cost me? What's the cost? What's the return? What's the break even? When will this money that I spend give me something back in return? And how much in return, the K that you're looking at, how much is my return on the investment? And some companies, some multinational organization they want a return for every project, every subsidiary has to fall into that. That's the corporate goal. And the subsidiaries, they want to be part of the organization have to maintain that goal. And remember, the goal financial trickles down. For the manager to make that goal, his or her assessments or bonuses are tied to the corporate goal. Financially, you can't play with them, but all the numbers come back, so everyone gets rewarded financially, or they lose financially if they don't achieve the goals. Again, so my name is Dr. George Mochoc. You made it to the first chapter with me, International Finance. This is Chapter 1, Financial Management, a multinational corporation. And basically, we're going to be looking at that perspective from a multinational. So if I'm a small business, I'm importing and exporting, but maybe I want to open up an operation there because it makes sense. You could basically utilize the same strategy. Okay? So again, my name, you're taking me online or face-to-face. It's a supplement. Read the book. Follow the examples. Take your time. Don't read it when you fall asleep. Be sharp. Add on to this. Look at it. Read it. Listen to this. You understand the concept. Understand the vocabulary. The formulas will come in. You already know how to do some of the formulas, calculators. Plug them in. You'll do fine. And I'll see you in Chapter 2 going forward. And thank you for taking this course. And you'll do well. You'll understand the international financial side strategically, why companies and how they operate. Thank you.